Number one, trading instead of investing. Back in 2007, when I was a young banker on Wall Street, I got excited about day trading. So day traders make quick bets on stocks or currencies or crypto. You buy at 10 a.m., you sell at 10:15, you make a fast profit and repeat. To younger me, trading seemed super exciting. I was sure I was about to get rich, but it didn't go that way. I remember betting on Boeing stock only to watch it crash, or selling a losing stock just before it shot up in price. I just couldn't make a consistent profit, and I felt horrible about it until I looked up the data and discovered that the vast majority of day traders lose money. I have known a few successful traders over my career in finance, but most of them work for a big bank or hedge fund. They trade with other people's money. Most small traders who play with their own money end up losing. And to me, this makes trading one of the worst ways to spend your life because it takes a huge amount of time and effort and your average expected result is negative. Today, instead of trading, I invest my money. As an investor, you find valuable assets that create wealth for you. These are investments like stocks or real estate that grow in value over time, that give you cash flow, give you an income. So you find these investments and you hold them long term and you allow them to make you wealthy. This works much better than trading, and the best part is it leaves you free to spend your time on your job or business or family or hobbies instead of staring at market charts all day long. Next mistake, investing naked. No, I'm not talking about flashing your neighbors as you buy a share of Tesla. I'm talking about the mistake that my friend Jerome made back in 2009. It was the middle of the financial crisis. Stocks were down 50%, and Jerome sold half his stock portfolio. Not because he wanted to. He knew that the market would recover, but he had just lost his job and he simply needed the money. Jerome's mistake was investing naked. He didn't have a safety cushion to spend in case of emergencies. If you invest without a safety cushion, you will be forced to sell at the worst possible time. So always keep a bit of cash in the bank. Next, not investing enough. Look, I'm embarrassed to admit it, but even though I learned how to invest on Wall Street 18 years ago, I only started investing significant amounts of money around 9 years ago when my son was born, and I realized that I needed to get serious. I had all this investing knowledge, but for years it gave me close to zero benefit. The thing is, investing can only multiply the money that you put in. If all you invest is 20 euros a month, well, that's a good start, but it's only a start. Let's run some numbers to understand this better. Let's say you have no savings to start with and you invest 20 euros a month and you get a profit of 9% per year. So that's a pretty good result, right? Well, if you do this for 10 years, you will end up with 3,800 euros. Now that is something, right? But it's not a life-changing amount. To get real significant results, you will probably want to invest 200 euros per month. When in 10 years you might have 38,000, or in 20 years that would give you 128,000. This kind of money can already have a big impact. It can be enough to start a business or buy a property. Okay, so if you want investing to change your life in a significant way, you need to invest a significant part of your income. The more you put in, the more you get out. Here's a related mistake: overestimating risk. I think one of the reasons I delayed investing for years is that I started my career in finance back in 2007. That was right at the start of the financial crisis. I sat on the biggest trading floor in the world at UBS as the stock market kept crashing and crashing and crashing. As major banks like Lehman Brothers and Bear Stearns collapsed, as my friends and colleagues lost their life savings, it seemed like there was no safety anywhere. And even though intellectually I understood the power of investing, even though I knew that the market would eventually recover, I think that this early experience scared me off for a long time. Now, over the following 18 years as a finance professional, I have lived through various market dips and crashes. The worst came in 2020 when, as a pension fund CEO, I had to answer calls from worried clients when COVID caused the market to fall by more than 30%. But now that I look back at the past 2 decades, major crashes have actually been very rare. If you look at even longer-term historical data, on average, the stock market goes up around 3 out of every 4 years. And when the market does fall, the average drop is fairly small. And after every one of those drops, eventually the market recovers. So patient investors usually make a lot of money. It is just that the big crashes, when they happen, they are super scary. They leave a big psychological impact. So don't make my mistake. Don't let the fear of risk stop you from investing. The real risk is leaving money to sit in your bank account. Next, here are a few of the most expensive mistakes that I've seen my clients and students make. The first one is buying individual stocks. The other day, I ran a beginner investment workshop where I talked about how profitable stock investing has been. One of the attendees actually stood up and said, "That's nonsense. I've been investing in stocks for 10 years, but I haven't made any money." I could guess immediately what the problem was, because over the past 10 years, global stock markets have been tremendously profitable. But if you pick just 3 to 5 stocks to buy in your portfolio, there's a big chance that you will lose money. If you look at decades of data, you discover that the average stock in the market actually loses investors money. Many big famous stocks like Enron or Lehman Brothers or Bed Bath & Beyond or Kodak have gone to zero. But that's not the only bad thing that can happen. As many as 40% of all stocks experience catastrophic losses of 70% or more, and they never recover from these losses. The stock market has been tremendously profitable not because most stocks are winners. They are not. It's been tremendously profitable because a few top stocks are so extremely successful that they pull up the average for the rest of the market. So if you try to make money by picking individual stocks, chances are you will fail. Now, you might think, "That's dumb, Tom. I'm not going to pick stocks at random. I'm not going to pick losing stocks. I will only pick the winners." Well, this leads us to the next extremely common mistake, which is chasing hot stocks. Today, the 5 hottest stocks out there are probably Nvidia, Microsoft, Apple, Amazon, and Meta. They are the big 5 in the S&P 500. People ask me constantly about these stocks. And listen, I'm not telling you that these are bad investments. With the AI revolution happening, there are certainly good reasons why many investors are excited about these companies. But if we look at history, we notice a pattern. In 1990, the 5 biggest stocks in the S&P 500 were ExxonMobil, IBM, Walmart, Bristol-Myers Squibb, and Merck. Out of these, only Walmart outperformed the S&P 500 over the next 35 years. In 2000, the 5 biggest stocks were, again, ExxonMobil, General Electric, Cisco, Pfizer, and Walmart. And once more, only Walmart outperformed the S&P 500 over the next 25 years. In 2010, the 5 biggest were Exxon, Apple, Microsoft, Berkshire Hathaway, and Walmart. Of these, Apple and Microsoft outperformed until today, while Walmart more or less matched the performance of the S&P 500. The thing is, the biggest and hottest stocks of today are often not the best performers going forward. That's because any stock which is hot today is likely already expensive. You cannot jump in and buy it at a cheap price. To be really successful picking individual stocks, you would have to guess the next Nvidia, the next Microsoft, the next Google before everybody else. And that is extremely difficult. That is why, for amateur investors, chasing hot stocks is usually a mistake. You are usually better off buying an index fund or ETF, which will put your money into hundreds of different stocks in different regions and industries. This not only gets better results, it's also a lot less work. But when people here in Europe decide to invest in ETFs or index funds, they often make the next mistake, which is following American investment advice. When I moved home to Europe after 8 years in America, I felt like I'd landed on a different planet. There were different investments, different regulations, different tax rules for everything. And this is something that stops so many beginning investors here in Europe. You Google index funds or ETFs, you find a great blog or book or video from some American educator, and you try to follow the instructions, but you hit a wall. Because of EU regulations, you can't buy American index funds and ETFs in most European countries. Most American brokerages won't accept European clients. And American tax advice about their 401ks and IRAs and long-term capital gains doesn't really apply to us here in Europe. Instead, as a European, you should use a local brokerage or investment app to make your investments. You should follow the tax rules of your local country, and you should invest in ETFs and index funds which follow European regulations. By the way, the best place to find these ETFs is a website called justetf.com. It's a great database listing over 3,000 different ETFs that are available to us here in Europe. Which leads me to the next common mistake, picking the wrong ETF. There are actually two ways that people often mess this up. The first way is strategic. People often ask me, which S&P 500 ETF should I buy? As if the only way to invest is to buy the 500 biggest American companies. Now, to be clear, the S&P 500 has been a great investment for decades, and it might still be a great investment going forward, but it's not the only possible choice. You should ask yourself questions like, do I want to invest 100% of my money in stocks, or should I also look at lower risk investments like bonds? Should I invest only in the American stock market, or should I also look at Europe or Asia or emerging markets? Before you jump straight to choosing a specific ETF, think about your strategy. Okay, and then there's the second type of ETF mistake, which is technical. For example, this could be buying what is called a distributing ETF if you are a long-term investor in Portugal. Because with these distributing ETFs, you will be paying dividend taxes on your ETF income every year, which you could have avoided by buying what's called an accumulating ETF. Another mistake could be buying a Luxembourg-based, physically replicated global stock ETF, because this means that you would pay extra tax on dividends from American stocks compared to an ETF that is based in Ireland. Now, that might sound complicated, but here's the thing. For every major market index, like the S&P 500 or the FTSE All World, there are many types of ETFs which track this index. You have accumulating and distributing ETFs. You have physically and synthetically replicated ETFs. You've got ETFs based in Ireland and ETFs based in Luxembourg. Each of these has different tax consequences. Each of them will get you different results depending on the country where you live. Plus, in some countries, like Spain, you might not want to buy an ETF at all. You could get a better tax result by investing in index mutual funds instead. So the technical mistake is not optimizing your fund choice for your personal situation and your local tax rules. I've actually put together a training on how to choose the best ETFs or index funds for investors here in Europe. Just click the first link in the description of this video to watch it. But now, let's address another common beginner mistake, which is chasing dividends. And the idea is appealing. You invest in a few great companies, they earn a profit, and they pay you a dividend, which lands in your bank account. You're getting cash from your investments. What's not to love? Well, as it turns out, there's plenty not to love about dividend investing. First of all, when stocks pay out dividends, usually there's some kind of tax involved, which takes away part of your money and reduces the capital that you have available for future growth. This is one of the reasons why many of the biggest companies in the world pay less and less and less in dividends these days. Instead, they use other mechanisms like share buybacks to compensate investors. And second, many dividend-paying stocks, which pay the highest dividends, actually give you poor overall results. They are missing the second half of the profit equation, which is growth. One of the most controversial truths in investing is that dividends are simply not that important. Chasing dividend-paying stocks does not improve your expected returns. Now, here's another mistake that I once made myself, ignoring taxes. When I moved back to my home country, Latvia, after working in America, I didn't investigate Latvian tax rules closely enough. I thought I was paying what I was supposed to, but one day I got a letter from the government which said, "You owe us money." That was pretty stressful, and it cost me a good amount of cash. Don't make the same mistake. As soon as you make your first investment, you are subject to investment taxes. Research what taxes you need to pay in your country before you get started. And if you're an expat or digital nomad, check in which country you need to pay these taxes. Messing this up is an easy way to get into not just financial, but also legal trouble. In a moment, I'll share a resource that makes this easy. But first, here's another big mistake: timing the market. Look at this chart of the S&P 500 over the past 25 years. Wouldn't it have been smart to buy at these times when stocks were cheaper? And sell at these times when the market was at all-time highs? People ask me this all the time, and I tell them, brilliant idea, I wish I had thought of it first. Okay, that's not what I tell them, because in reality, market peaks and bottoms are only obvious looking backwards. At any given point in time, there is no way to predict whether the market is about to fall or whether it will keep climbing. If you wait for the next big crash to buy, sometimes you may have to wait for many, many years. And when that crash comes, that is usually a scary time. There are lots of new headlines predicting basically the end of the world. It's very hard to convince yourself to buy stocks at a time like January 2009, the depths of the financial crisis, or March 2020 when COVID hit. There's been a huge amount of research done on this, and the conclusion is pretty much 100%. If you try to do market timing, chances are you will spend a lot of time and energy, you will suffer a lot of stress, and you will almost certainly fail. There's a reason Warren Buffett said the only value of stock forecasters is to make fortune tellers look good. There's a reason Nobel Prize winner Robert C. Merton called market timing a fool's errand. It simply doesn't work. The best approach for ETF and index investors is to start investing today and to keep investing on a regular basis, no matter what happens in the market. Which brings me to another important point. Sometimes new investors don't want to deal with the stress of managing their own investments. So they go to their local bank and say, take care of investing for me. And this leads to a major mistake, which is paying high fees for investment advice that you don't understand. A few years ago, a friend came to me and said, my banker put together this portfolio for me. What do you think? And look, I can't give people investment advice. I don't have a license for that. But I did want to kind of laugh and cry at the same time because this portfolio had something like 20 different ETFs and investment funds, some of them actively managed with high fees. Every time that my friend would invest some money, he would pay a bunch of fees to buy each of these funds. Plus, the bank was charging him 1% per year just to manage his money. It was basically highway robbery. And unfortunately, it's very, very common. The typical investments offered by your local bank here in Europe are expensive and will get you poor results. But here's an even bigger danger. When you follow the advice of your banker and buy investments that you don't understand, that doesn't actually take away your stress. It increases your stress because you're risking your life savings on a strategy in which you have no confidence. Like my student Anna said, how can you trust your financial future to something you don't fully understand? Now, the good news is, investing is not such a hard skill to learn. You just need to answer a few questions like, which ETF or index fund is best for you? What brokerage can you trust? And how do you handle taxes? Well, the best way to answer these questions is to watch an in-depth video on this topic that I put in the comments.